Well, good morning. My name is Greg Keough, and I'm CEO of Finova Financial. And today I'd like to talk to you about a multi-trillion-dollar change in the way equity capital is both raised and traded. I'm talking about digital equity securities, or equity tokens as they're being called. This is entirely based on the blockchain, and it's a new way to capital formation instead of the traditional VC model. So what I talked about today is three things basically. First, the traditional model of funding and how it's morphed. Secondly, the Delaware blockchain initiative, and this is how the glue that holds this new ecosystem together. And third, a new pathway from initial funding of a company all the way through publicly traded entity called the Jobs Crypto Offering, or JCO for short, that we created with our law firm Cooley. Oh, this is the wrong slides. Okay, so we're going to jump through some here because it's a little shorter than the normal presentation. So if you look at the VC model today, it's actually the exact opposite of what blockchain does. It's entirely centralized, and it's based basically in geography and in Silicon Valley. So you have a small group of people deciding basically what to invest in or not. It's not democratized, so if you look at a few folks are deciding what's good and what's bad. And if you look at it, it's really a totally not an efficient system. If you look at the rounds of funding, only about 95% of folks who go to get venture capital, only about 0.5% can actually get it, and they fall off as you go through the different rounds. Now, with all that, as that's been the go-to model for over decades of successful companies, you'd say well, it must be really successful. But if you dig down into the details, you'll see that 95% of VC funds either break even or lose money. So it's not exactly such an efficient model. And you don't have to take my word for it. You can ask the founder of Casa Ventures, who basically says, he thinks that most VCs don't add much value, and some, even worse, may even hurt the company's chances. So what are the strategies that really make somebody successful or not in this pathway is basically, he says, look for entrepreneurs, serial entrepreneurs who've done this before, and they tend to be the most successful. So if you look at the VC model, it's actually not it's the anti-blockchain model, basically, for lack of a better word, but where they are successful is looking at companies, getting them from its initiation, and bringing them all the way through to IPO. This is where the 5% make most of their money. And so this is a key factor here on why they're still around. If you look at the next model, we had crowdfunding and Indiegogo, which basically put investors and projects directly together. And while it raised smaller amounts of money, one of the big challenges was that it was interesting that anybody in a democratized way could put up their idea and get funded. But the real benefit was that this interaction directly with the community and presenters or projects was very, very efficient. The downside is that basically there's no path to liquidity. So why haven't these all replaced the traditional paths? Fast forward, and we have the latest opportunity, the ICO. And so when this came out, it was really awesome because for the very first time, you had a new technology being used, kind of decentralization of blockchain and cryptocurrency. And then you had kind of just raw capitalism, right? So it's kind of the Wild West where anything went, and tons of money was raised. Those of you who were around for a while know that initially VCs didn't think too much of this process, but now many are involved. And you even had companies like Filecoin using a little bit of crowdfunding with their angel list partnership or coin list partnership to raise larger sums. And so very interesting. But the real problem, I think, is you can see a major shift happen, that this was really good until it went bad. And I remember back when I first got involved in 2012 or so in kind of blockchain and Bitcoin, I was actually running this joint venture they mentioned between MasterCard and Telefonica. So I was the CEO for Global Mobile Financial Services. So really heavy regulatory, compliance, legal issues on a global basis. And my son, who was a gamer, I have 5 kids, wanted to use his machines to mine Bitcoin. Now think back, this is 2012. And so I was helping him set it up, and that actually worked out pretty well for him because he paid for his own college. But the main question he kept asking me was, will this stuff ever be regulated? And my answer was, yes, it will be when it gets big enough. And I think if you fast forward to today, we see that that's what's going on, right? So the SEC itself says that many of these ICOs are indeed securities in their mind, and therefore need to comply with securities laws. And I'm not so sure that's a bad thing. I think having guardrails along the system is a good thing. So I think, but the new reality is, if we're going to use blockchain and crypto and technology to fundraise in a different way, we kind of have to make sure, or you have to be very cognizant, that you're riding the rails of what is appropriate from a legal perspective. So if you look at the bar, or the barrier to entry from the very first ICO, which was generally real cutting-edge folks using the blockchain and crypto in new ways, but you really didn't need to have a ton of money for legal, compliance, regulation, international aspects of this. Fast forward to today, those skill sets now are very important, and also they require capital. So it's changed a little while. So I've been an entrepreneur since the 90s. I was around during the internet day, and I always went down an approach of raising venture capital. And I don't know if you folks have had this situation, but have you ever done something that you're just used to do, and then you're like, well, why am I actually doing this? It doesn't make a ton of sense. And so when I started Finova, we went down that traditional path. We've raised over $100 million. Our money from the VCs comes from top-tier Silicon Valley guys. We are a financial services company. We lend, and so our debt comes from private equity guys. Mark Spilker, who was the former president of Apollo, the hedge fund, and former Goldman Sachs guy. So good investors. And but really, I said to myself, is this the right way to build things going forward? Finova already has millions of dollars in revenue. We have operations and regulated operations in 7 states, and we were talking about how to scale this. And kind of my aha moment was, we had a term sheet, and I was sitting down with a really great venture capitalist, who I will not name, who's backed by other kind of funders, who I also won't name, but really smart guys. And I came away saying, like, it's great they want to get involved, but like, if I started this company over Finova, would I do it the same way? And the answer was no. And the main reason? The Delaware Blockchain Initiative. So in August of last year, Delaware, which by the way, 83% of all IPOs come from, 65% of all publicly traded companies are based there, came out and said, hey, the blockchain is great to track stock transactions, and we're going to embrace this. This is a fundamental change. You had a main corporate sponsor in the United States state saying this was important. And so when I looked at the blockchain initiative and then looked at the ICO and the new realities of funding, et cetera, I said there's basically got to be a better way to do this. Is there a way you can push the benefits of blockchain and the ICO in with the more traditional IPO approach? And so I sat down with Cooley, who are attorneys, and said, I believe there's got to be a better way to do this. And we came up with something that mixes Reggae, Reggae, and a lot of other funding models into what we call the Jobs Crypto offering. Now, the idea of this is you can go down this path of the JCO, or Jobs Crypto offering, from company formation all the way through to publicly traded entity. You can do this in one foul swoop. You can do it tranched in little bits at a time, but it gives you the flexibility to leverage the best of crypto and blockchain within the legal framework. So how does it work? You start with a Reg D, and that is based on Delaware Blockchain Initiative, and you can push your equity stack onto the blockchain and tokenize it. These are done by SAFs, but it's not the SAFT you've been seeing if you've been investing in utility token SAFs. This is a different SAFT. It's for digital equity securities. So these are ERC tokens that allow you to both own ownership and equity in the company, as well as receive dividends or anything else, quite frankly, you program in there. After that phase is done, if you want to go further, where you want actually a liquid market to this, you can go down through what's the Reggae Plus process. Now, this is an existing process with the SEC where you can raise up to $50 million from both accredited and non-accredited investors. There are guardrails in place. You need 2 years audited financial statements, full corporate team. You need to practice background checks and all the other items. But this allows you then to tokenize that equity. And then the last stage is a Reg A Plus actually gives you the right to go on NASDAQ directly. But you now, because you put the equity on the blockchain and tokenize it, you could take that same token and you could trade it on an ATS. So an alternative exchange approved by the SEC, or where I think this is actually going, I believe NASDAQ and many other larger exchanges are going to embrace this just due to the sheer size of the opportunity. So if you look at investing as a whole, right, you either kind of believe that the ability for folks very efficiently to kind of cut up the equity stack and be able to provide unique benefits of it as well as the benefits of investors on a global basis who are basically locked out of good opportunities, this is a trend that is going to continue, and this is what's going to unlock a lot of that wealth I was talking about. Moving from centralization to total decentralization in a way to connect people one-on-one. And if you look at it basically, who are the investors of tomorrow, right? They're likely millennials and Gen Z. Gen Z is going to be much, much bigger than millennials. And if you look at what they want to invest in, they're not interested in a share of Ford stock. They don't know who Jamie Dimon is, and they don't care what he says. These are digital natives who are used to doing things with technology. So the fit in the migration of equity and digital equity securities or equity tokens to the blockchain is a perfect fit for this huge investment class of group of people that have yet to enter the formal system. The ICO was the very first glimpse into this, but I think you're going to see a future whereby all the benefits of blockchain and crypto will merge with regulation to provide pathways all the way through from project initiation to traded equity on an exchange using this Jobs Crypto Offering Process, or JCO. Thank you very much for your time. I appreciate it.